your attention, and if you can think of some good questions to ask him, I'm sure that he'd be eager to answer those questions.
Not too good.
Well, I'll turn it over to you. Thank you.
Well, I guess I want to thank Billy for inviting me. I've never ever, this is the first time I've ever either spoken or I guess taught, I don't know if that's the correct word, a college course, so this is kind of new ground for me too, so I guess thank you for inviting me out. I got a copy of your textbook to look at last week, and I'm just glad I'm not taking this class. You guys, that's pretty intimidating, everything that's covered in there. But what I'll try to cover today is it'll probably be more from a business approach in real life as opposed to what's in the book, and I think that's really what Billy is looking for as far as the approach to having outside speakers come in and give you maybe some real life examples of ethics as I've seen it, maybe through my banking career, and how it fits into the real world and what you're talking about. First of all, I've got a little outline here, but I'd just like to ask or state that let's keep it real informal. If anybody has any questions or comments or disagreements or observations, be sure to just jump right in. Secondly, like I said, I've got a little schedule to go through, but I'd like to ask is just anyone, if they would, what's your observation of banking today? From a standpoint of maybe from an ethical standpoint or even from a business standpoint, what do you perceive that a bank stands for and what does it mean? You might want to jump on that. A place you keep your money, maybe. A place that you go borrow money. Would it be generally be good or bad? There's some surveys, depending on, I guess, from a banker standpoint, which one you want to look at. Some surveys say that banking has ethically and the pecking order has a pretty good reputation. You know, and then there'll be some surveys that you read that bankers as a whole, the reputation is not all that good. So I was hoping maybe we get passing marks from this crowd this morning. First of all, just to spend a little bit of background as to what banking's all about, and from a structure standpoint, the background and the regulatory requirements that banks are faced to kind of build a basis for why maybe banking or ethics in banking is important is that for the most part, banking is a fairly highly regulated industry. There's a lot of structure, there's a lot of form to banking as to how it's evolved over the years, and with the primary purpose of protecting depositors' money. That's, you know, we're going to talk about a lot of that, but that'll be the thrust as to why the structure is there, is that when you take, you know, your $100 up to the bank, you want to make sure that on Friday it's there, that you can get it out. And that's the whole basis that the system is built on. But through that, there, you know, and it's really evident in today's market. You all have probably read in the paper where Bank 4 has bought this bank, and Nations Bank has bought this bank, and yet we've got First National Bank of Okmulgee, and you've got First National Bank of Henrietta. How does all that fit in from a structure standpoint? Well, historically, particularly in Oklahoma, we were known as what was called a unit banking state. Back prior to the mid-70s, one person or one company could own one bank. You couldn't have multiple ownership of banks. So the people that own, say, the First National Bank of Okmulgee, that's the only bank they could own. And that's called unit banking, and you were allowed one bank. You weren't allowed any branches. All we could have would be that main banking facility with a limited drive-in facility. Starting in the 70s, the structure started changing somewhat, and it got to where then there was a deal that was devised called multi-bank holding companies. And what that said was that a corporation, a company that say owns the First National Bank of Okmulgee, within the state of Oklahoma could own more than one bank. So now you had maybe a company that could own the First National Bank of Okmulgee and let's say the Western National Bank in Tulsa, and under that umbrella you could have multiple ownership of banks. Well, what that still didn't allow, that wasn't still a very efficient system to deliver banking services from the big bank standpoint. So what they changed in the 80s was now that they allowed limited branching. And so a bank could come in and basically have 2 branches, and it's real complicated. We won't get into that. I could spend an hour trying to explain how the branching structure works. But basically in the state of Oklahoma, they said you could have limited branching, and you could have two branches within the state. Or if you were bought by another bank, then that would count as an unlimited number of branches. So that's sort of where we are within the state today. As you can see, when you've probably read where Bank 4, say in Tulsa, has been buying a lot of banks. Bank of Oklahoma has been buying a lot of banks. What they are doing is converting all these banks to branches, because through acquisition, you can have as many branches as you want. If you were to want to go out and what they call de novo, or start a new branch, you're only allowed 2. Now the big push just this last week that's coming out of Washington, that the bureaucrats up there are pushing, is that they want to have interstate branching. We have intrastate branching now, and basically what that would say is that Chemical Bank in New York could come in, and whatever form they allow them to do it, they could have a branch here in Okmulgee. Right now, they can't have a branch. The Chemical Bank from New York could come in and say, buy the First National Bank of Okmulgee, and they could operate it as a bank, but they couldn't operate it as a branch. And the basic distinction between owning it and operating it as a bank and owning it and operating it as a branch, let's say from the consumer standpoint, would be the availability of doing your banking at multiple locations. When it's a branch, you can go cash a check, deposit a check at any location, because if you look at those little numbers on the left-hand side of your check, that basically says that that's all one bank with multiple locations. If it's a multi-bank situation, then you've got separate routing numbers, and you can't accept deposits and cash checks that way. So really, from a nationwide standpoint, branching is a more efficient system. We talked a little bit about multi-bank holding companies. That there again, that's just a technique that was out there for people to own banks, and we talked a little bit about branching. As I stated earlier, banking is a highly regulated business, and that's primarily due to the protection that's afforded to depositors through the Federal Deposit Insurance Corporation, or the FDIC insurance, which I'm sure you all have heard about. There are within the structure of banking, there are ways that banks are regulated, and there are basically 3 entities that regulate banks, and it depends on whether, one, you're a national bank, which you've heard of, like the First National Bank of Okmulgee, the bank I work for. Then there are state banks. Moore State Bank is a state bank. The difference between that would be that a national bank is chartered and basically governed by the national or the federal government, where a state bank is chartered by the state banking commission, and it's a state organization that organizes and charters state banks. Now, both banks have FDIC insurance, which is a federal program. And because of that, it gets a little complicated as to, okay, who's the chief regulator for a national bank, and who's the chief regulator for a state bank? Because through the federal insurance program, the federal government still has their fingers, if you will, on us as to what we can or can't do, because they provide that very important deposit insurance. Okay, national banks are examined and regulated by a division of the Treasury called the Office of the Comptroller of the Currency. And that's the, quote, the bank examiners that we've all heard about. I used to be one of those guys. That's how I got my start. And I've got a few ethical stories I'm going to share with you in a minute about some of the things that I saw as a bank examiner. But the OCC, or the Comptroller of the Currency, examines and regulates national banks. And they are then insured by the FDIC, that branch of the federal government. State banks are examined by the State Banking Commissioner and the Federal Deposit Insurance Corporation. And they examine the state people, take care of the state banks, the FDIC, because they don't have this OCC examining a bank. They have to go in and make sure that the bank is safe and sound, and that we're not doing imprudent things that would cause the bank maybe to fail. And when the bank fails, then it puts your deposits at risk, or it puts the FDIC insurance fund at risk. All right? Any questions about the way banks are structured and the way the banks are regulated? As I stated a second ago, the whole banking system is a system built on confidence. You take $100 to my bank today, and you want to be sure that come Friday when it's time for the weekend and you need a little weekend money, that you can get your money out, and that I haven't taken that money and squandered it. And as it pertains to your class, that to me raises probably the number one ethical issue from a banking perspective is that you've got honest, ethical people working in a bank. Whether it's me as the president of the bank that's responsible for everything that goes on, all the way down to that teller that handles thousands of dollars in transactions and is responsible for literally thousands of dollars of green cash every day. So as you can see, it is an ethical business. That it's important that you've got honesty, integrity, and a high degree of ethics in our business. That unfortunately hasn't always happened. We've had our black marks and problems in the financial business, whether it's banks that have had bankers that have embezzled, all the way to the S&L scandal, which we'll talk about in a little bit, and all the problems that involve with that. But it is a system of confidence. Basically, we're intermediaries that say, okay, we're going to pay you a certain percent on your money collectively, and that we've got 6,000 or 7,000 customers. We're going to take that money, and for people that have needs to borrow money, we pool that money together, and we have to take it and make loans to individuals for cars, homes, businesses, whatever. And that spread that you make is what we get compensated for in taking and managing that risk and managing that effort to collect that money and take care of it. So anytime you handle money, whether it's in a bank or whether it's a cashier at Wendy's or whether it's receivable clerk for a company, there's ethical issues that pertain that say you've got to just treat that special, and it raises a lot of ethical issues. Historically, some of the things that have, from an ethical standpoint, that have faced the banking industry, and unfortunately, the negative news kind of makes the headlines, and that's all you hear about. You don't always hear about the good things, for the most part, that people do, whether it's in the banking business or whether it's out here at school. But probably of recent times, the first one, and most of you all probably may not even been born when this happened, but in the mid-'70s, there was a fellow by the name of Bert Lance. Has anybody ever heard of Bert Lance? Anybody ever heard that name? Got one, maybe? Well, Bert Lance was a banker from Georgia, and he was back in President Carter's administration, the director of budget. Well, just by chance too, that he was a somewhat unscrupulous banker, in that he was I guess you could say, the epitome of the good old boy, and he used his bank back in Dalton, Georgia, to say, okay, I'm going to do this and this, and basically what he did was he stole from the bank. I mean, he would do insider loans. He would come in, let's say, as the president of the bank, and say, okay, I'm going to loan myself $200,000 to go make this business venture. When in essence, if you were to walk in and say, Neville, would you loan me this $200,000 for this business venture? Maybe you didn't have the collateral, or you didn't have the down payment, or whatever it took, and I should have said no. But because of his position in the bank, he had no one, quote, there to tell him that he couldn't do that. He just went ahead and did it. And through the Bert Lance scenario in the mid-'70s, there was a regulation adopted by Congress called Regulation O. And if you're in the banking business, as with any government entity, we've got FIREA. There's other things we call that, which you can imagine. But Reg O, Reg Z, Reg DD, Truth in Savings, Truth in Lending. We've got all these acronyms that go with dealing with the government. But anyway, Regulation O came into play, and basically what that said was that as a banker, whether you were the owner, the president, or an employee, or an officer, there are certain things that you can or can't do as far as insider dealings with the bank. There's certain disclosures that you have to make. And it really tightened down on, like, for me to go borrow money at First National, really all I could borrow money for up there is I can borrow money to finance my house, and it's got a dollar limit on it. And I think it used to be $50,000, and I think they moved it up to like $80,000 now, that a bank can loan an officer or a director or an owner. And then I think they've got where I could borrow $10,000 for the education of my children. And short of that, I can't borrow money from my own bank, which, I mean, it's good, I guess, from the sense that protection's there to make sure that there's abuses, that there are not abuses in the system. But it's bad from a standpoint, you know, there were back then 15,000 banks and only one Burt Lance, and he sort of ruined it for everybody, which I think you all can recognize that's the case that happens in real life, whether it's in banking or whatever. One bad apple can really spoil things for everyone. But Burt Lance was the first one. He was, as far as an unethical banker and a fellow that started bringing regulation on our industry, he was really the first one of modern times that started putting more regulation and more controls over the banking industry.
What you're saying is that another citizen such as I could actually borrow more money from your bank than you could.
Right, yeah, and our directors. Now, directors, there's a little more flexibility because most of the directors have businesses that they have to run.
And that's one of the problems that Regulation O has for business and banking. They can borrow a little bit more, but they can't borrow without the same controls that, say, someone off the street can borrow. So, you know, that makes it a real disadvantage where you want to have directors that are good business people, and usually good business people have a need for a bank. They need to borrow money. You know, that's how we make money, is we don't make it, we have to have a source to turn around and loan funds out that people give us for deposits. And typically, you want your directors to be your best loan customers. Well, if all of a sudden the government says that, well, Jim, I can loan you $1 million, but Fred Harmon, one of our directors here, has a dealership in town. Fred, because of regulation, I can only loan you $300,000. Well, it puts banks at a real disadvantage in doing business with their directors. But it's just something you have to learn to deal with. They over the years they've tightened and loosened regulation though, and it's hard to keep up with. I mean, what I say today will be different 6 months from now. After Burt Lance, we had another dilemma that unfortunately originated here in Oklahoma about 10 years ago. Does anybody remember what happened on July 5th, 1982? Anybody want to venture a guess? Okay, I'll give you one more. It happened in Oklahoma City, and it happened with banks, a bank. Penn Square, there you go. We were both on track right here, Penn Square Bank. That was another situation that there were excesses, and not that there's debate as to how criminal things were. I don't know that there were that many criminal convictions, but there were definitely some unethical banking practices happening at Penn Square Bank. And just to refresh your memory, and for those of you that haven't ever heard of Penn Square, what Penn Square was a little shopping center bank at Penn Square Mall in Oklahoma City. And it started out just as a small suburban bank, and there were a couple of people who got control of the bank, and right as the oil business started in western Oklahoma in the 70s. And basically these folks got a hold of the bank, and they had contacts in the oil business, and they were going to be the bank of the oil industry for western Oklahoma. And to make a long story short, they basically, if literally there were people that had been, you know, not in the oil business, let's say a banker or a policeman or somebody that didn't know an oil well from a Ferris wheel, that would go in Penn Square if they liked you and you liked to drink and carouse with them, you know, and all that sort of stuff, then, you know, they'd just loan you $1 million, you're in the oil business. You know, you go out and maybe buy leases, and there's a lot of airplanes bought, and financed by Penn Square with no really sound economic basis for what they were doing. Okay, so they were just throwing money, and they really excavated the oil boom, if you will. There was definitely an oil boom, but it was probably magnified 2 or 3-fold by what Penn Square was doing, because they were just throwing money. They would take maybe an oil prospect out in western Oklahoma that in today's times might be marginal at best. But you know, if I just give you $1 million and say go drill an oil well on it, don't worry about paying it back, or we'll worry about that later. Well, sure, you're going to drill oil wells all over the place. And through that money flowing, there's going to be false economies in some of the towns in western Oklahoma, where all of a sudden there might be a need for a service company or a roustabout company that didn't exist 5 years before, and from an economic standpoint, really didn't have a need to exist anyway, because it was kind of a false economy. Well, Penn Square did all that, and the reason I bring that up is that it had a significant impact on banking and some of the regulations, some of the impact that happened through that whole deal. They basically caused about the 6th largest bank in the country to fail. You know, we talked a minute ago about gathering deposits and loaning money, and I'm going to loan you $1 million for that crazy oil well. Well, how does a little suburban bank that's not really wasn't even any bigger than our bank here in Okmulgee generate billions of dollars worth of loans? They didn't have $1 billion worth of deposits. You know, they didn't have that many deposits. So how did they get the money to loan all these people these dollars? Well, what they did was a deal called participations. What they would do is they would say, okay, I'm going to loan, what's your name? John. I'm going to loan John $2 million on this oil loan. Now, I don't have the money to do that. I'm the bank talking, because I don't have enough deposits. But I've made an arrangement with an upstream bank, one of the big banks in Chicago or New York, primarily Continental Illinois, which was one of the largest banks in the country. They got down here and they were seeing this boom in Oklahoma, and being greedy bankers that they were, they said, we want some of this action. And so they would come in and buy this loan, buy this participation. And there were literally billions of dollars of these loans went to Continental Illinois, Chase Manhattan Bank in New York, Seafirst in Seattle, and basically through this false economy, Seafirst in Seattle, which was one of the nation's largest banks, and Continental Illinois, which was like the nation's 5th largest bank, they basically failed because they bought so many bad loans that they didn't have the capital and the ability to absorb all that. And they were literally, Continental was taken over by the FDIC. Seafirst was acquired by Bank of America. So you can see the impact of that. A little suburban bank in Oklahoma City and Penn Square Mall literally had impact on what happened from either coast, from New York City to Seattle, Washington, and it was all negative. Okay, well, ethically, they didn't do right. They not only were they not very smart people, they were unethical people, because what they were doing was wrong. And there's a difference between, I make bad loans all the time. Well, not all the time. If I made them all the time, I'd be fired. But you know, in good faith, I'll make a loan to John, and up front it looks like a good deal, but maybe all of a sudden the meteor hits his business and it fails. I mean, you know, there's sometimes things that people can't control that cause businesses to go bad, and that's not unethical. That's risk taking. I get compensated, and as a bank, we get paid to measure risk and how much risk can we take. But what they did was beyond the normal risk taking. Okay. So that created another round of regulations, and then we basically, the banking business, it became more controlled from the standpoint of government regulation of our business. And there was a lot of fraud involved. And you can imagine, anytime there's easy money, just think about it, common sense says when it's easy to get a loan, there's going to be a lot of fraud and a lot of abuses in that situation out there where it's just too easy. You know, it may be, and there was one or two convictions where I go to John and say, okay, John, I'll give you that $1 million loan. Now, how about you getting me some tickets to the Super Bowl? You know, you got $1 million, surely you can get some tickets to the Super Bowl. Or even, how about you giving me a little bit of kickback? You You know, I'll give you $1 million, now you give me $10,000 in $100 bills, nobody will say anything, okay? When easy money's out there and there's no accountability, can you see how that'd be pretty easy for that to happen? And that gave our business, the banking business, really a black eye. As to one little bank, a real small bank, in the middle of the heartland in Oklahoma City, did that. If you can think the magnitude when you talk about billions of dollars, and you talk about it basically bringing to its knees 2 of the 10 largest banks in the country, that's pretty intimidating. More recently, the S&L scenario, which you all have probably all heard about, that's happened just in the last 5 or 6 years. And without getting into a lot of the technicalities on that, that's just another situation where the S&L business, and not so much the banking business, but we're all, people perceive banks and S&Ls as being financial institutions, so we're all kind of in it together. But they had a lot of trouble, and there was a lot of fraud in what happened with the S&L industry. There again, there were a lot of abuses, there were a lot of unethical people. But having said that, there were a lot of just genuine situations where the economy and the changes in the tax laws caused the S&Ls to have a lot of problems. If you could just conceptually think about this, FDIC insurance, remember that's the confidence builder that we have in the system. You put $100,000 in our bank where it's FDIC insured, you're going to get your money back, guaranteed by the government, basically, or an agency of the government. Well, what would happen was S&Ls were allowed to do a lot of crazy things, okay? And some of them were not illegal, but they were unethical. Some of them were probably not illegal, not unethical, but just not very sound. But nonetheless, they were allowed to do a lot of things. They were allowed to go into real estate ventures. If you're going to come to our bank and borrow money for a home or a real estate project, you've got to have a down payment, and that's typically about 20%. So if you want to borrow $1,000, you put up $200, the bank will loan you $800. That gives us protection, and if you default, then we're not going to lose any money. We're not going to lose any of the depositors' money, and that's the way it works. S&Ls were allowed to basically make that same loan, but that $200 down payment, they could say, now, John, I know you don't have the $200 to put down, so you and I are going to be partners, equity partners, and we're going to, you go do this real estate apartment project in Chicago, and we'll basically loan you 100% of that. Now when you get that sold, finished and sold, you're going to make $1 million on that because we gave you the money to be the down payment. We're going to split that. Perfectly legal, but Congress had allowed savings and loans to do that. They hadn't allowed banks to do that, thank goodness, because they make us require down payments, but they allowed savings and loans to do it because if you look at a savings and loan, they were chartered basically to encourage people to invest money in real estate, to build houses, to build these projects. Well, back in the 80s, they changed the tax laws. Real estate investment became not such a good investment. We went into a recession, and all of a sudden these real estate projects that S&Ls had financed all over the country, all over Oklahoma, that were worth $1 million or had $1 million worth of cost in them, let's say. Now all of a sudden, we've all seen real estate values over the last 4 or 5 years go down. Now all of a sudden that real estate project was maybe only worth $700,000. Not only was the $200 that I get, the example I used a while ago, gone, but they couldn't even pay the loan back. Okay, so you can see how there was a loss in that project, and there were billions of these around, all over the country. It wasn't isolated to Oklahoma. Well, the reason I go through all that is to show you that there are abuses in that system. And there again, some of these weren't unethical. I mean, some of these were legitimate situations where the laws allowed people to do that. Maybe not very smart business moves, but nonetheless they could do that. Well, we had S&L's collapse. The fund that insured deposits at S&L's, it went bankrupt. The government had to bail it out to the tune of about $120 billion. That's billion with a B. That's a lot of money. So you can see that when that happened, all of a sudden the government and Congress came back and said, wait a minute, we've had this big fiasco. We're going to tighten down on the banking / financial institution industry. So anyway, there's another round of regulations to make sure that quote, bankers remain ethical from the standpoint of what you can and can't do in the banking business. So I just tell you all that to just let you know that I guess from a sense that there's a lot of things that we can't do in the banking business. There's a lot of things that laws that are out there to keep us honest, if you will. And it's like anything. It's unfortunate that there were probably a minority sort of ruined it for the majority, because most people in the S&L business, they were ethical business people. I read something from the Federal Reserve that I think that of all the problems of S&Ls that failed, about 15% of them the failure was attributed to fraud. Where someone there again we were making loans and doing self-dealing under the table, and self-dealing is where the situation I gave a while ago was that I'll loan you $100,000 and maybe it's not a very good deal, and it's the bank's money and it's not cable's money, but for that you give me some Super Bowl tickets. Or let's say that John comes in another form of self-dealing, something that's unethical. Let's say that John's got a good idea to invent a new parachute or something, or a Nintendo or something that's going to be a craze. And the banker says, well, that's a good idea. And he's an entrepreneur, venture capital guy, and he's got a great idea, but he didn't have any money. And like a lot of us, like me. So he comes to the bank, and Mr. Banker says, well, that's a great idea. Now, I'll tell you what I'll do. I'll loan you that $100,000 to get started, but I want a piece of the action. You think that'd be very ethical? Say, you're going to give me 10% of your company, and 10% of the profits on the side, not part of the compensation for the loan. That wouldn't be very ethical, would it? So that's where these laws come in to protect situations where that doesn't happen. And unfortunately, it's happened over the years. Every time. Okay. What, until? 8:25. I don't know if it would interest you. I thought trying to think about what I would talk about today, and there again, I was a bank examiner after I got out of school for the OCC here in I worked out of Tulsa, Eastern Oklahoma, and I did that for 4.5 years. And I thought, just from an ethical situation as it pertains to the banking business, I'd just share a couple of stories with you where I was involved in catching the crook, if you will. Two situations where and it's kind of ironic, the 4.5 years I was on, these were the only two situations that happened in the whole state. So it's not like don't want to make you guys think that, man, somebody's stealing at First National right now, because it's really the exception rather than the norm. But I thought I'd just share a couple of stories of how they did that, because I thought they were kind of interesting. You guys may think they're boring, but the first one was, we were in a bank in, I'll just say, Southern Oklahoma, and we were doing our regular exam. And back in those days, what the examiners would do is you would get control of all the assets. I mean, you'd come in and you'd control the vaults, you control all the ledgers, because if somebody was pilfering with the numbers, you wanted to be able to grab them right then and not give them a chance to go back and fix what they had pilfered with or changed. So we kind of swoop in and get control of all the cash and everything. And then what we would do, we were really more like auditors and examiners. And we'd come in, we'd audit, count the money, we'd make sure if the bank said they had $1 million worth of loans, that they actually balanced, and that there was $1 million worth of loans, and that there wasn't a fraudulent loan. Me as the bank, I could go back to the bank right now, and I'd get caught, but I could go back and make a $1,000 note and put it in John's name, and put a post office box on it, and take a $1,000 cashier's check and make it, and then take that check and go endorse it. I could do that right now. I mean, that could happen. I'd get caught tomorrow, so it wouldn't be very smart. But having said that, that loan that's on our books wouldn't be worth anything, would it? Because it would be a fraudulent loan. What the examiners would do would go in and make sure that all the loans that were on the books, that the proceeds from the loans were dispersed properly, that John borrowed the money, and that he got the use of the funds. Well, we used to do all that. Well, we had one situation where we were in, and back in the old days, before they had computers, they had either things were posted by hand, or they had these manual big adding machines that posted everyone's account. Well, this one particular machine posted loan payments and interest payments on their, on this one big sheet of paper. And think about it from a bank standpoint, the way we make money is on interest income, okay? We charge you 6%, we pay someone 4%, so we make that spread. Well, the income part of that is anytime someone pays interest to the bank, that's income to us. Well, in this old manual system, they posted all these, all this income every day. If you paid $300 in interest on your note, you paid $400. At the end of the day, they totaled it up, and maybe that was $20,000 or $30,000 in interest that was paid to the bank that particular day. Well, they had these big sheets, and just by chance, I glanced at one of the sheets, and there was down at the bottom where they were balancing that day, in the teller window, there was a deal that said $2,000 and had brackets around it, interest rebate, and it lowered the interest income from, say, $20,000 to $18,000. Well, wouldn't you think that would be a little unusual that there'd be interest rebate of $2,000 even? If you pay your car off, you know, and you get a rebate on your car loan, is it going to be $50 even? It's usually $49.84. So I just glanced at that, and I asked in fact, it was a man that was a teller. I said, "What's this deal here?" He said, "Well, I don't know exactly what that is. The president of the bank, we do this interest rebate, and it's a $2,000 deal that we do, and I don't know. He just tells me to do it, and he takes a bundle of $20 bills. And $20 bills, when you bundle them, you know, you've seen them maybe in the bank. Well, a bundle is $2,000 even, so it's an easy, you know, it's as opposed to having $1,500, which would be loose. You just grab a bundle of 20. He said, well, he would take the $20 bills. He says, I need to transfer this interest to the head teller in this cash. So he would take the $2,000 out of the teller window. She would lower her income by $2,000. Well, that teller would balance, if you can visualize that. So the $2,000 never got put in the bank's income. Well, he would take it and take it up to the head teller, and he was trying to hide his trail. He was trying to get this money, and he was trying to move it, and he was trying to hide his trail. Well, he would take it to the head teller and deposit it with her money, and then he would take out $100 bills and tell the teller up there that he's transferring it to another teller. Okay, so in essence, what he was trying to do is just leave a trail of how he was moving this money. Don't you guys take notes on this and think you can get away with this? You'll always get caught. But so in essence, when the whole transaction was completed, what he would do, he'd have $2,000 sitting on his desk. Well, I found this out subsequent, but I asked this fellow, I said, "What's the deal?" He said, "Well, the president of the bank does this," and I said, "How often does he do it?" "Oh, he does it about once a week." I knew right off that wasn't kosher. You know, that $2,000 interest rebate. You always have those loans that might pay off every day, but they're going to be, you know, $144.63 and those kind of adjustments. So I asked this guy, I said, "Well, he does it every day." I said, "Well, you have any more of these tapes?" He said, "Yeah, they're all right here." So I pulled another one out. Sure enough, the Wednesday before, maybe, there was a $2,000 interest rebate. So I said, "Well, where are all these things?" So he said, "We're all right here." Well, they were like butcher paper, you know, and they were rolled up, and there were probably 40 of them or more. So I said, "I need to take these up and look at them." So I grabbed all of them, and you know, I sort of lumbering around, and I had to walk right past his office, and he looks up at me, and you know, if ice would be, you know, a .357 Magnum, I'd have been a dead man, because he gave me a look like, "What in the are you doing with that?" So sure enough, to make a long story short, we took it up there and we found out that the guy was stealing $2,000 a week from the bank, and we caught him. Ironically, he was stealing $200 every Monday. And what he would do the same day, he would take that $2,000 and he'd go to safety deposit box. If he did it on November the 13th, that day or that evening, there'd be an entry where he'd go to his safety deposit box and check in, and every time that there were $2,000 gone, that same day there was an entry where he'd go basically put the money in the safety deposit box. Same guy, and you know, this talk about unethical. Every Monday he stole $200. There was a $200. No, the first month, let's see, this was, I have to think, this was 20 years ago, so I have to remember this story. the first Monday of every month, he would go through and steal $200. And what he would do is he would take $200 out, and he would in turn deposit it to his checking account as a cash deposit. And then he had it for his local church. The bank would automatically transfer $200 the first of every month to his local church to make his tithe and offering for the month to the church. So he was stealing $200 a month from the bank to give his offering to his church. So anyway, needless to say, he was caught. We confronted the board that evening, and it was pretty easy to put together what he was doing. And once we sort of found out about it, employees, they weren't stupid. They knew what he was doing, but this particular fellow was pretty intimidating, and they were fearful for their job, to be honest. So, but once they sensed that we were on point and that we were about to get this guy, I mean, the whole deal came in, and they started telling us other places to look, and we ended up getting, if you will, and he ended up stealing about $190,000. And ironically, he paid the money back to the bank, and didn't serve it. The FBI got involved, and there was an FBI agent, and they were checking him. And we did a lot of the work, but they checked the records to build the case against him, and he was charged and got a suspended sentence. Was a convicted felon, got a suspended sentence, didn't have to spend any time in jail, primarily because his family had enough money they were able to pay the money back. So, but nonetheless, he was kicked out of the bank that evening, and from a standpoint of ever getting back in the banking business, I mean, that was 20 years ago, and he ruined his reputation. Another story, that a quick story was my first week, or not my first week, about my fourth week as an examiner. We did these deals where we would reconcile. Banks keep checking accounts with big banks. That's called a do from account. You can imagine that. We at First Okmulgee have to have an account to do our banking, if you will, with, let's say, a bigger bank. So that account has to be reconciled. Some accounts every day because of the number of transactions, but just as hopefully you all reconcile your checking account once a month, but that account has to be reconciled every month. Well, this story was, there was a lady that in another small bank, and not too far from Okmulgee, that was always one of the things that the low man on the totem pole had to do as an examiner. You had to go in and you had to do all the number crunching part of the exam. The head examiner got to rub shoulders with the president and go play golf and do all that sort of stuff. And some of the rest of us had to do all the work. But anyway, one of the things that you had to do, that person was called the scut. I don't know how they came up with that name, but that was what we were called, was the scut. You had to scut the exam. So one of the things that you did was you had to get these accounts reconciled. And we always put it off to the last because you had to get your bank statement. And depending on the bank, it was kind of a hard situation because this particular bank had a lot of Visa transactions where they were clearing their Visa deposits, where a merchant would do a Visa deposit and deposit in the local bank, and then it would be sent on the Visa. Well, anytime there's rebates, it's real complicated, but there are a lot of transactions back and forth, and it's hard to ever get these cleared off because you're dealing with Visa in New York City, and you can never get your money, so it's always a hard account to reconcile. Well, I was fairly new, and it was a Friday, and the fellow that I was working for always wanted to be finished by noon on Friday, so we could wrap up the exam, and we could be gone, and he could go play golf, and whatever. So about 11 o'clock, he asked me, he said, "How are we doing?" I said, "Well, we're doing okay." He said, I think we'll be through except for this one account that I was learning. I didn't know how to do it. I said, "Mike, you may have to help me with this account because I'm going to have a hard time reconciling it because it's got all these adjustments." And he said, "I don't have time." He says, "Just get the lady, the cashier, to help you with it." Well, that was kind of a no-no because you're supposed to be independent. You're supposed to do it yourself, and you're going to make sure that she doesn't trick you and try to reconcile it. So I said, "Well, okay, I want to leave by noon too." So I go back and ask this, well, I'll call her Susan. That wasn't her name. I go in and I said, "Susan, this due from account up at, I think it was National Bank of Tulsa." I said, "I'm having a hard time reconciling this," and I was subsequently going to say, "Would you help me reconcile it?" Well, I said, Susan, I'm having a hard time reconciling this, and she just burst out, I didn't mean to take the money, I'm sorry. And, you know, she kind of starts crying, I'm going, here I am, you know, 21 years old, and never had anything like this happen before. So come to find out what she did, and it wasn't very much money, but she hid in that reconcilement about $400. You know, ran out of money to payday, and an easy way to do it was to make an internal accounting entry to where she credited her checking account for $400 and debited this account, and it was an outstanding item that until she put the money back, it was never clear. And just by chance, I found her, you know, and anyway, she was nonetheless, you know, from the bank standpoint, she was an unethical person. She, albeit it was only $400, you know, she stole money from the bank. I think it was her intentions to pay it back, but she got caught. I tell you those stories just to, because I think they're kind of interesting, but you guys probably don't, but I do. But just to let you know that, you know, whether you're the president of a bank, you know, there's a degree of integrity that's required, whether you're a teller or a cashier in this case, and whether it's $400 or $190,000, there's a degree of integrity that has to be in the banking system. Because, you know, I'll go back and I'll harp again. The banking system is built on confidence that when you put your money in our bank, that you know that one, I'm not going to make bad loans, and two, that I'm an ethical person, and I'm not going to take those funds and squander them, or I'm not going to steal them. And if you don't have that system then in place, then, you know, whether it's the First National Bank of Okmulgee or whether it's the whole system nationwide, then the delivery system of dollars collapse. If you don't, and you can even convey this to the insurance business. You know, the insurance companies are just kind of big banks, if you will. We pay premiums to them. We give them money. They collect it. They hold it. They invest it. You know, they make loans. And if I didn't have confidence in Metropolitan Life Insurance that it was going to be around a year from now when I needed a claim, then I'm probably not going to give them my money. So just remember that you have the whole idea of integrity and in the banking system is there so we can have confidence in the system. A couple of things just from a standpoint of what I see as far as ethics or morals of bankers is that we talked about safeguarding depositors' assets, your money. That's very important. We handle a lot of money. You know, as tellers will go through, particularly like right now, the first and the second, third of the bank. I mean, literally they'll go through several thousands of dollars in the normal course of business to the bank. So you have to have honest, reputable people there. The public image, you know, these stories I've told you aren't very pretty. And if that's all you heard, and a lot of times that's all you do here, it doesn't paint a very pretty picture for our industry. So it's important that we don't have these kind of problems on an ongoing basis. And because hopefully you hear all the good things that banks do, like participation in the pecan festival and those kind of things. Those aren't quite as sensational as if you find that the president of the bank's been stealing or that someone gets caught stealing. It just doesn't have quite the spice or the sex appeal to it that the others would. The other thing I'd leave with you that from a bank standpoint, you always get caught, whether from an ethical standpoint, from the banking perspective, you know, the debits and the credits, I would always get caught. I made a situation where I could make a fraudulent loan to today. I may not be tomorrow, but I would get caught, whether it's the day after tomorrow or next Monday, because there's audit trails and it's just going to happen. And I think you could say the same thing, that if you do things that are unethical in the business world, you'll always get caught. It may be a subjective kind of thing that there's not an audit trail, but you know, if I get the reputation around town as being a gossip and a bad mouther, it's not going to hurt me from a standpoint of making a bad loan, but it's going to hurt me from a standpoint of having credibility, so I get caught, if you see where I'm coming from a standpoint of you're always accountable and credible, or accountable for your actions. Our bank has a code of conduct that every employee has to sign, and And basically, it's about a 4 or 5 page document, and they basically say that, you know, they're gonna do things that always represent the bank's best interest, that they're not gonna do things that embarrass the bank, that ethically they're gonna, you know, take care of their own personal finances in such a way that it's not an embarrassment to the bank. I probably should have brought a copy of what that says, but it basically says that they're not gonna deal with customers, you know, they're not gonna do, I'm not gonna be in business with John. I've agreed that to my board of directors that, you know, when I deal with the customer, it's gonna be on an arm's length transaction, and that we're not gonna do things together. That's not business-wise, that's not that we couldn't be friends, and that we can't socialize, but when it comes to business, we separate the business from the social aspect of it. And that's good, because that keeps, if I have to, you know, if I loan John money and we're good friends, and all of a sudden he has business and I've got to be a horse's rear about collecting it, you know, then our friendship's not at jeopardy. Not to say you shouldn't do business with friends too, because if we took that approach, we probably wouldn't have any customers. We talked a little bit about the conflict of interest and arm's length transaction. Confidentiality, that's critical in our business, that what goes on in the bank stays in the bank. I don't think you would want battered around town that, hey, Billy, Miss Brandon's got, man, she's got $1 million down at the bank. You know, you can appreciate the fact that, by the way, I'm gonna buy you lunch too, for $1 million. But you can appreciate the fact how important that is. And we stress that's part of that code of conduct. It's very important to our business, and all banks are gonna have that. Confidentiality is really important. Just real briefly, we're about out of time. I think there's also ethics and morals of borrowers. It's people tell you something and they don't hold their end of the equation up. Bankruptcy is much too easy. And well, I can start getting a little philosophical here, but you think about it, you know, it's just become too easy for people to file bankruptcy. I mean, it's an easy way out. Most people, as opposed to stepping up to the bar and saying, let's figure out a way, I borrowed the money in good faith, I want to pay it back in good faith. All too many people just say, well, I borrowed it, and I'm not going to pay it back, and that's your problem.
What kind and how much credit does an individual need to come into your bank and try to get a loan?
Well, it just depends. I mean, if you're going to borrow money for a car, it's much easier than if you're going to, you know, want to borrow $100,000 to put into your business. I would recommend to where you don't have credit. There's a lot of ways you can do it. You know, whether it's through the bank, coming in, borrowing small amounts of money, and just showing the ability to pay it and the willingness to pay it back. Credit cards, while I don't advocate going out and getting $100,000 of credit cards, my first credit was I think I had a $75 limit with Gulf Oil Company, you know, but I got that credit card when I was 19 years old, and it was important to me. I mean, that was the way I established credit. And I didn't get a $5,000 credit card from Visa, some of us get, and what have you. I was going to do a handout. What I may do is go ahead and just hand these out, because we're about out of time. And you can read these, and I'm glad we're out of time, because that way I don't have to answer what you might do in these situations. But these are just some situations that I came up with that, you know, based a little bit on what we talked about today, and you might just think, what would you do in each one of these situations? How would you handle it? And as you can see, there's sometimes not easy answers to pretty tough questions when you get out to the business world as to what do you do to handle specific situations. And I can attest that these are real life scenarios that either have happened personally to me through my experience or to people in real life situations. I just close by saying that from the banking business, our standpoint is built on integrity, it's built on trust, it's built on confidence, and if we didn't have all of that, if we didn't incorporate those aspects into the banking business, the company wouldn't be like this. And, so, you know, ethics as it pertains to